Welcome to the Retirement Wealth Podcast, where we help you navigate the path to a secure and fulfilling retirement. I'm Emily Parker.
And I'm David Carter.
Today, we're diving into an age-old debate that many people face when planning their retirement: real estate versus stocks.
It's a fascinating topic, and it really gets to the heart of how we think about building and preserving wealth for retirement.
Right. Both options have their pros and cons, and understanding them can really help listeners make informed decisions.
Exactly. We'll explore how each investment can fit into your retirement strategy, what risks to consider, and, of course, how to balance them to match your personal goals.
Plus, we'll touch on some real-life examples and maybe share a few tips on how to get started, whether you're leaning towards real estate, stocks, or even both.
It's all about finding the right mix that works for you, and we're here to guide you through that process.
So let's jump right in. David, can you kick us off by sharing some of the key benefits of investing in real estate for retirement?
So, Emily, when we think about why this topic, real estate versus stocks, is especially important right now, it really gets to the heart of what so many people are facing as they approach retirement.
Absolutely, David. With inflation being such a hot topic these days, it's really impacting how folks view their retirement plans. The rising costs of everyday living can make even the most solid financial plans feel a little shaky.
Exactly. Just last week, I spoke with a couple, let's call them Tom and Linda. They're in their late 50s and are starting to feel the pressure of rising prices. They had always assumed they'd be able to rely on their investments in the stock market, but now they're worried about how that's going to hold up against inflation.
Right. And it's not just about what they have saved up now. It's about what their money is going to be worth in 10 or 20 years.
Yes! And this is where the concern about market volatility comes in. The stock market can be unpredictable, and for those nearing retirement, those fluctuations can feel particularly nerve-wracking.
Totally. I remember hearing about another retiree, Susan, who was ready to retire just as the market took a downturn. She had to reconsider her plans, which is such a stressful position to be in.
It really is, and that kind of uncertainty can lead to emotional strain. Who wants to feel anxious about their financial future, especially after working hard for so many years?
Exactly, and let's not forget about Social Security changes. With discussions around potential cuts or adjustments, it's becoming more crucial than ever to have a well-rounded strategy in place.
Right. Many people depend on Social Security as a safety net, but it's not the only piece of the puzzle. It's important to consider how other assets, like real estate or stocks, fit into that plan.
And healthcare costs are another big factor. They're only expected to rise. I often hear from retirees who are shocked by how much they're spending on health insurance and out-of-pocket expenses.
Yes, and if you're relying solely on your stock market investments, those rising healthcare costs can really take a toll. Real estate can serve as a hedge against some of those costs.
That's a great point. For example, if you have a rental property, the income from that could help cover those expenses.
Exactly. And it's also about legacy planning. People want to leave something behind for their kids or grandkids, and having real estate can be a tangible asset that can be passed down.
Right, and that's something that stocks don't always provide in the same way. Real estate can offer that emotional connection, like a family home that holds memories.
I think we're seeing a shift in how people are viewing their retirement portfolios. Many now want a balance between assets that can provide income and those that can appreciate over time.
Yes, and with the current economic trends, it seems that a diversified approach is more important than ever.
It really is. For instance, let's say someone has a well-diversified portfolio that includes both stocks and real estate. If the stock market dips, their real estate could potentially keep them afloat.
And not to mention the tax efficiency of real estate. Many retirees don't realize that there can be significant tax advantages to owning property, particularly if they've lived in it for a long time.
Exactly. Homeowners can benefit from things like the capital gains exclusion when selling their primary residence, which can be a real plus for their overall financial situation.
That's a great way to add to their retirement income without facing a big tax hit.
And let's not forget that, in many cases, real estate values tend to appreciate over time, helping to combat inflation.
It's like a natural hedge against the rising cost of living.
Yes, and considering all these factors, it's clear why this discussion matters now more than ever. People are looking for ways to secure their financial future amidst uncertainty.
So true, David. It really underscores the importance of having a solid financial plan that takes into account these various elements.
Absolutely, and this leads us into some core strategies that folks can consider when thinking about their own retirement planning.
Yeah, let's dive into those strategies next.
So when we're talking about real estate versus stocks for retirement wealth, it really comes down to what you're comfortable with and your overall strategy, right?
Absolutely, David. I mean, real estate often feels tangible. You can see it, touch it, but stocks can offer some pretty compelling advantages too.
Right. And let's not forget about liquidity. Stocks are generally much easier to convert into cash. You can sell shares in minutes. Real estate, on the other hand, can take quite a while to sell, especially in a down market.
That's a good point. Plus, there are the ongoing costs with real estate, like property taxes, maintenance, and insurance. Those expenses can really add up.
Exactly. And then there's the potential for appreciation. Historically, stocks have outperformed real estate in the long run, but real estate can provide consistent cash flow through rental income.
Yeah, and that cash flow can be a huge benefit in retirement, especially if you're relying on that income to cover living expenses.
Right. But let's talk about diversification. A solid strategy often involves a mix of both. For instance, a classic rule of thumb is to aim for a 70-30 portfolio, 70% in stocks and 30% in bonds or other fixed income investments.
And then you can sprinkle in some real estate, whether it's direct ownership or through real estate investment trusts, right?
Exactly. REITs can be a great way to get real estate exposure without the hassle of being a landlord. Plus, they often pay dividends, which can be a nice income stream.
That sounds like a good balance. Now, what about tax-advantaged accounts? How do they fit into the mix?
That's a crucial piece of the puzzle. With a 401k or traditional IRA, your contributions are tax-deductible, which can lower your taxable income now. But remember, you'll pay taxes on withdrawals in retirement.
And with a Roth IRA, it's the opposite, right? You pay taxes up front, but your withdrawals are tax-free in retirement.
Exactly. And that can be really beneficial if you expect to be in a higher tax bracket later in life. Balancing these accounts can help manage your tax liability in retirement.
So, if someone wants to withdraw money, what's a smart strategy? I've heard of the 4% rule.
Yes, the 4% rule is a popular guideline. It suggests that if you withdraw 4% of your retirement savings each year, you can expect your money to last for about 30 years. But, of course, it's not one size fits all.
Right, because market conditions can change. What if the market takes a dive and you're withdrawing 4%?
Exactly. That's why some people prefer the bucket strategy. It segments your portfolio into different buckets based on when you'll need the money.
So, for example, you might have a bucket for short-term needs filled with cash and bonds, and then another for long-term growth invested in stocks?
Exactly. The short-term bucket keeps you from having to sell stocks in a downturn. It's all about managing risk and ensuring you have access to cash when you need it.
Speaking of risk, how can someone minimize taxes on their investments?
Well, tax loss harvesting is a technique where you sell investments at a loss to offset taxable gains. This can help reduce your overall tax burden.
And what about required minimum distributions, or RMDs? I know those can be a surprise for some folks.
Yes, RMDs kick in at age 73 for most people now, and failing to take them can lead to hefty penalties. So it's important to plan for that.
Planning is key, isn't it? You don't want to be caught off guard by unexpected tax bills or penalties.
Exactly. And that's where a good advisor can help. They can help you strategize withdrawals and ensure you're taking advantage of all available tax-saving techniques.
Speaking of strategies, I've heard people talk about using annuities for guaranteed income in retirement. What are your thoughts on that?
Annuities can be a useful tool for some people, particularly those who want guaranteed income. However, they can come with high fees and complex terms, so it's essential to understand what you're getting into.
Yeah, it seems like it's really about finding the right mix that aligns with your goals, risk tolerance, and income needs.
Definitely. And don't forget about Social Security optimization. The age you choose to start receiving benefits can significantly impact your overall retirement strategy.
Right. Waiting until full retirement age or even age 70 can increase your benefit amount. And that's a big deal for many retirees.
And you can also consider strategies like file and suspend, or restricted application if you're married, which can maximize benefits for couples.
So let's recap. Diversifying between stocks and real estate, using tax-advantaged accounts wisely, managing withdrawals with strategies like the 4% rule or bucket strategy. It all ties together.
Absolutely. It's about creating a comprehensive plan that takes into account your unique situation.
And speaking of unique situations, what are some common pitfalls people should watch out for in retirement planning?
Great transition. One of the biggest pitfalls is underestimating healthcare costs. Many people overlook how expensive healthcare can be in retirement.
Yes, and that can really throw off a budget if you're not prepared for it.
Exactly. Another common mistake is not having a clear withdrawal strategy. Without one, you risk depleting your savings too quickly.
And sometimes people forget to consider inflation when planning their withdrawals, right?
Yes, inflation can erode purchasing power over time. It's crucial to account for it in your financial projections.
Wow, it sounds like careful planning really makes a difference.
It really does. A well-thought-out plan can help you navigate the complexities of retirement and enjoy your golden years with peace of mind. You know, Emily, one of the biggest pitfalls I see with retirees is something called sequence of returns risk. It sounds complex, but it really boils down to the order in which your investment returns happen, right?
Absolutely. It's so crucial. I mean, if you experience a market downturn early in your retirement, while you're still withdrawing money, it can have a huge impact on your portfolio's longevity.
Right, and I've seen retirees who plan to withdraw a certain percentage for living expenses, but if they hit a bad market year right off the bat, that withdrawal strategy can quickly become unsustainable.
That's a tough situation. Do you have any anonymized examples of that happening?
Sure. There was a couple I worked with. Let's call them Tom and Linda. They retired in 2008, just as the market crashed. They had a solid plan, or so they thought, but they hadn't accounted for that downturn. They were withdrawing 4% from their savings, but the market decline meant their portfolio was shrinking instead of growing.
Ouch, that must have been stressful for them.
It really was. They had to adjust their lifestyle drastically because they hadn't planned for that sequence of returns risk. It forced them to reconsider their entire withdrawal strategy, and it was a hard lesson learned.
So what can retirees do to protect themselves against that risk?
Well, one strategy is to have a diversified investment portfolio that includes a mix of assets, stocks, bonds, and maybe even some real estate. This can help cushion the blow during market downturns.
That makes sense. And I guess having a cash reserve can also help, right?
Exactly. Having enough cash or cash equivalents set aside can allow retirees to ride out market volatility without needing to sell investments at a loss. It's all about balancing that withdrawal strategy with market conditions.
I love that perspective. What's another common mistake you see?
Ignoring taxes when planning withdrawals is a big one. Many people think about their retirement savings in terms of how much they have, but they forget that taxes can eat into those funds as well.
That's so true. I've heard stories of retirees getting hit with a big tax bill because they didn't plan for it.
Right. I had a client named Sarah who was so excited to retire. She had a nice nest egg, but she didn't realize that a large portion of her savings was in a traditional IRA. When she started withdrawing, her income spiked, and so did her tax bracket. She ended up paying way more in taxes than she anticipated.
Wow, that's such an important detail to consider.
It really is. Planning withdrawals strategically, maybe by taking out from taxable accounts first, or being mindful of how much you withdraw from tax-deferred accounts, can make a significant difference.
Definitely. And I think we can't forget about healthcare costs, especially as we age.
Absolutely. Underestimating healthcare expenses is another critical pitfall. Many retirees assume Medicare will cover all their needs, but that's not always the case.
Yeah, I've read that healthcare costs can be a huge burden in retirement.
Exactly. I had another client, let's call him Mike. He was healthy when he retired, but didn't account for potential long-term care needs. A few years in, he started having health issues, and the out-of-pocket costs for care were staggering. It really derailed his financial plan.
That's so unfortunate. So how can someone prepare for those unexpected healthcare costs?
Planning ahead is key. Setting up a health savings account, looking into long-term care insurance, or even just budgeting for higher healthcare costs can help. It's essential to have those conversations early.
And what about longevity? That's another factor, right?
Yes, absolutely. Many people underestimate how long they'll live. I often hear retirees say they plan for 20 years, but with advances in healthcare, many are living 30 years or more in retirement.
That could really stretch a portfolio thin if you're not prepared for it.
Exactly. Like with another couple I worked with. They thought their retirement funds would last them into their 80s, but they both lived into their 90s. They had to tighten their budget significantly in their later years, which was difficult for them.
Wow, that's a tough reality.
It really is. But it's all about assessing your own health, family history, and planning for a longer retirement than you might expect.
And what about asset allocation? How does that come into play?
Poor asset allocation can be detrimental too. Some retirees become overly conservative, shifting too much into bonds or cash too early, especially after a market downturn.
Oh, I see what you mean. They might miss out on growth opportunities.
Exactly. A balanced approach, adjusting your allocation as you age but still keeping some growth-oriented investments, is crucial. I had a client who panicked after a market drop and moved everything to cash. They missed out on the recovery, which hurt their long-term growth.
That's a classic example of reacting to the market instead of sticking to a plan.
Right, it's so important to have a solid plan and stick with it, even when markets are volatile.
So, what can listeners do to recover from these pitfalls or avoid them altogether?
Well, first, they should review their withdrawal strategies regularly and adjust based on market conditions. Second, consider working with a financial advisor who can help navigate the complexities of taxes, healthcare, and investment strategies.
That's solid advice. It's all about staying informed and being proactive, right?
Exactly. And don't hesitate to reassess your plans as your situation changes. You can never predict everything, but being prepared can make a world of difference.
I love that. It's about being adaptable and informed.
Absolutely. And that leads us right into our next steps for creating a solid retirement plan, which we'll dive into next. All right, Emily, let's dive into some actionable steps that our listeners can take right now to strengthen their retirement plans.
Absolutely. So, what are some immediate things folks can do?
Well, first off, if you haven't already, I'd suggest checking out some retirement calculators. Vanguard, Fidelity, and Schwab all have great tools that can help you project your retirement savings and expenses. They're super user-friendly.
Yeah, I've seen those. They really simplify things, right?
Exactly. They allow you to input your current savings, expected expenses, and even factors like Social Security benefits. It gives you a clearer picture of where you stand and what adjustments you might need to make.
And what about Social Security? I think a lot of people overlook that.
Good point. Visiting SSA.gov can give you a lot of insights into your benefits. You can create an account, view your earnings history, and estimate your future benefits. It's crucial for planning.
For sure. And speaking of planning, any recommendations on tax software?
Yes. Look for software that offers tax projection features, like TurboTax or H&R Block. They can help you understand how your investments, whether it's real estate or stocks, will affect your tax situation in retirement.
That's so important. Taxes can sneak up on you if you're not careful.
Absolutely. Now let's talk about some financial planning apps. I'm a fan of tools like Personal Capital or Mint. They help you track your expenses, investments, and even your net worth in one place.
Those are great for keeping everything organized. And it makes it easier to see where you might need to cut back or save more, right?
Exactly. Regularly reviewing your portfolio is key. I recommend doing that quarterly. It doesn't have to be a huge time commitment, but it helps you stay on track.
And running those retirement projections can be eye-opening.
Absolutely. It's like looking at a roadmap. You want to know if you're heading in the right direction, or if you need to take a detour.
Right. And what if someone feels overwhelmed by all this?
That's totally understandable. Just start small. Maybe begin by setting aside time each month to review one aspect of your retirement plan. It could be as simple as checking your investment allocations.
That makes it feel more manageable.
Exactly. And don't hesitate to reach out for help if you need it. There are plenty of financial advisors out there who can help you navigate this, even if it's just for a one-time consultation.
Great advice. And I think it's also important to keep learning. Are there any books or podcasts you'd recommend?
Sure. The Total Money Makeover by Dave Ramsey is a classic. It's straightforward and motivational. For podcasts, I'd suggest The Retirement Answer Man. It covers a variety of topics in retirement planning.
Those are solid picks. I love that there are so many resources out there.
Absolutely. It's all about finding what resonates with you and making it part of your routine.
And it's never too late to improve your plan, right?
Exactly. Whether you're just starting to think about retirement or you're already in it, there's always room for adjustment and improvement.
So with all these tools and tips, listeners are really equipped to take charge of their retirement planning.
Definitely. So those are some practical first steps. Now let's bring this all together. Well, Emily, as we wrap up this discussion, I think it's important to reflect on some of the key takeaways from our chat about real estate versus stocks for retirement wealth.
Absolutely, David. One major point is how both real estate and stocks can play crucial roles in a retirement portfolio, but they serve different purposes, right?
Exactly. Real estate can provide that tangible asset feel, along with potential rental income, while stocks often offer more liquidity and the ability to grow wealth over time through capital appreciation.
And we also touched on the importance of diversification. Spreading investments across both asset classes can really help mitigate risk, which is super important as we approach retirement.
For sure. Another takeaway is the need to consider your personal financial situation and goals. Like, if you prefer hands-on management and have the time, real estate might be appealing. But if you want a more passive approach, stocks could be a better fit.
And let's not forget about the tax implications, right? Each investment type has its own tax considerations that can impact your overall returns.
That's a great point, Emily. Understanding these factors can really help in making informed decisions.
So as we close, remember that building and protecting your retirement wealth is a journey. It's important to stay informed and adapt your strategy as your needs and the market change.
Absolutely. And we encourage our listeners to take action. If you found value in today's episode, please like, subscribe, and leave a comment with your biggest takeaway or any questions you might have.
And don't forget to share this episode with someone who's planning for retirement or is already retired. It's always good to have these conversations.
Next time, we'll dive into how delaying Social Security impacts your benefits. It's a topic that can really make a difference in your retirement planning.
We can't wait to see you then. Thanks for joining us today.
Take care, everyone.
Bye for now.